At exactly 9:47 p.m. last night, while most people were asleep or numbing themselves with another scroll through their phone, 17 of the most powerful bankers in America received an encrypted message that made their blood run cold. I've seen what it said. And by the time you understand what those words triggered inside the Federal Reserve, you'll realize why everything you believe about your money, your savings, and the safety of the system you rely on is about to change. This is not a prediction. It's not a rumor. It's not market chatter. This is happening right now, today, Wednesday, January 21st, 2026. And if you click away before we finish connecting the dots, you will walk blind into the biggest financial storm of your life. In the last 20 years, that protocol has been activated only 3 times. September 2008, the weak Lehman collapsed and the global system nearly died. September 2019, when the repo market froze and banks quietly stopped lending to each other overnight. March 2020, when markets cratered and the Fed created trillions in weeks just to keep oxygen flowing. Last night was the 4th time. Jerome Powell, the most powerful central banker on the planet, pulled the lever that you only pull when you're staring straight at systemic failure. And the reason is something the mainstream will not tell you for weeks, if they ever tell you at all. Silver just broke $200 an ounce. Now stop, because I know what you're thinking. You've heard silver videos before. You've heard breakout, moonshot, short squeeze 1,000 times. But this is not about silver as a trade. Silver is not the story. Silver is the fuse. The bomb is your bank account. The bomb is your pension. The bomb is the entire architecture of the American financial system that has been held together for decades by confidence, paperwork, and the assumption that promises can substitute for reality. And last night, that assumption cracked. 3 months ago, right here on Money and Empires, we warned that the paper price and the physical price were going to divorce. People laughed. They said the system was too controlled, too engineered, too managed for real price discovery to ever happen. They mocked the idea that the market could break because they confused stability with safety. Stability can be manufactured. Safety cannot. And now those comments look like they were written in another era, because the thing that everyone swore could never happen has happened in real time. The end game doesn't arrive with a press release. It arrives with silence, with locked doors, with emergency meetings that don't show up on your calendar. At 9:47 p.m. Eastern, an encrypted communication moved through the Federal Reserve, or S, internal network to every one of the 12 regional bank presidents. This wasn't a polite invitation. This wasn't a when you have time. It was an order. Immediate virtual attendance. No delays, no excuses. Within 11 minutes, all 12 presidents were online. Within 14 minutes, Powell was speaking. Within 20 minutes, the people who hold the levers of the American economy were staring at their screens in a kind of stillness that only exists when the math stops working. Because here's what they saw. The paper market was still pretending everything was normal. Screens still showed a COMEX price under $80 an ounce. Business as usual, tidy and controlled, like the system was stable. But the physical market had snapped. Shanghai, where real metal changes hands between real buyers, wasn't trading a story. It was trading reality. And reality had no patience left for the paper lie. In that emergency meeting, the first thing they acknowledged was the most dangerous kind of break, the kind you can fix with a headline. The paper silver market was still running, still printing numbers on screens, still acting like price was whatever the futures contract said it was. But the physical market had already moved to a different universe. In Shanghai, delivery wasn't a promise. It was a demand. It was metal in hand. And the closing price implied a world where the real value of silver was nowhere near what the West was broadcasting. That disconnect isn't just a spread, it's an alarm. Because when the physical market refuses the paper narrative becomes a liability. Then came the detail that turned the room cold. Chinese state-owned entities had taken delivery of 47 million ounces in a single session. Not allocated later, not settled in cash, delivered, moved, claimed. And at the exact same time, COMEX registered inventory was sitting around 21 million ounces. If that number lands with you the way it should, you understand the meaning immediately. In one move, China demanded more physical silver than exists in the deliverable vault system of the United States. It wasn't a purchase. It was a challenge. It was the world walking up to the poker table, reaching across the felt and forcing the dealer to turn over the cards, and the cards weren't there. This is the part most people miss, because they think short squeeze is a trading term. It's not just a chart event, it's a truth event. For decades, the paper silver market has sold far more claims than it could ever fulfill with real metal. It operated on the belief that nobody would demand delivery at scale, because demanding delivery is inconvenient, expensive, and it exposes what the system tries to keep hidden. The paper market thrived because the public accepted a substitution. You don't need the metal, you just need exposure. You don't need delivery, you just need a contract. You don't need reality, you just need confidence. That only works until the day someone demands reality. And now it's worse, because this isn't just one market cracking. Silver is tied into a web of derivatives that makes 2008 look small in comparison. When banks build massive short exposure, they don't do it in isolation. They hedge the exposure with interest rate swaps, they hedge currency risk with FX derivatives, they ladder positions with options, they wrap it all in credit protections, and they spread the risk across counterparties until nobody remembers what the original bet even was. One short position spawns dozens of interlocking financial obligations. And when the price moves far enough, the whole chain starts pulling tight at the same time. Lehman's derivatives exposure was around $600 billion. That was enough to nearly end the global system. When you account for silver shorts plus the connected hedges, the counterparty exposure, and the cascading collateral requirements, we are staring at a potential detonation north of $1.2 trillion. That's not a loss on a chart. That's a liquidity event. That's a domino line stretching across continents. Now, quick pause right here, because if you want the truth in real time as this develops over the next 48 hours, you need to stay connected. Tap like on this video so YouTube actually knows it should show you updates when they matter, and subscribe to Money and Empires with notifications on, because when the system starts suppressing uncomfortable information, the only advantage regular people have is staying informed early. Do that now, and then stay with me, because the next step is naming who is trapped, and why this trap has no clean exit. The death bag isn't a metaphor. It is the concentrated short exposure held by a small cluster of major banks that have leaned on silver since the last cycle. Selling metal they don't to own, betting the world would never call for delivery and relying on the paper market. S ability to manufacture stability. That worked when demand was passive. It stops working when demand turns into a delivery request. By this morning, the death bag was sitting at an estimated 241 million ounces in short exposure. And that number matters because it's not just about losses. It's about impossibility. Even if you had infinite money, you cannot buy what doesn't exist at scale without detonating the market itself. At current physical prices, those positions are already deeply underwater on direct exposure. But the direct exposure is the smallest problem. The real disaster is the derivative chain attached to those positions. Because derivatives don't just lose money. They demand collateral. They trigger margin calls. They force liquidations. They pull other markets into the fire. So let's say it plainly. This is not a world where someone loses and someone wins. This is a world where the plumbing breaks. Deutsche Bank, UBS, after absorbing Credit Suisse exposure, HSBC, Barclays, and a rotating cast of major players have all lived inside this structure. They didn't just short silver because they hated silver. They shorted silver because controlling the price of silver helped control the narrative of inflation, the narrative of currency stability, the narrative that the system is functioning. Silver is the metal you cannot fake with speeches because it's industrial, it's strategic, and it disappears into real-world consumption. You can't print it. You can't stimulus it into existence. You either have it or you don't. And now the world is discovering how little of it is actually available when the buyers stop behaving politely. When a major bank can't meet a margin call, the story doesn't stay in that bank. It spreads instantly through counterparties. We've seen it before. In 2008, when Lehman couldn't meet obligations, counterparties panicked, collateral demands exploded, assets were dumped to raise cash, prices fell, and falling prices triggered more margin calls, which triggered more dumping, until the system was eating itself. That spiral doesn't require a villain. It doesn't require a conspiracy. It only requires leverage and fear, and both are everywhere now. But this time, there's a new variable, and it changes everything. The United States just shifted political posture toward the banks, toward the metals market, and toward the idea of bailouts itself. Because on January 20th, 2026, while cameras were focused on ceremonies and speeches, 3 executive orders were signed that rewired the risk calculation overnight. The first ordered a full forensic audit of COMEX and precious metals exchanges, not a friendly inspection, not a box-checking exercise, but a 90-day deep audit designed to expose fractional reserve practices. For years, critics have argued that Western silver markets operate like a paper warehouse with almost no metal behind it, selling claims at multiples of what can be delivered, relying on the fact that most participants never request the thing they supposedly bought. An audit makes that strategy lethal because fraud survives in ambiguity. It dies under a flashlight. The second order directed the Department of Defense to begin strategic stockpiling of physical silver for national security. Not exposure, not futures. Physical metal into military custody. Silver is critical in advanced electronics, missile guidance, satellite systems, battlefield medicine, and modern defense infrastructure. The order authorized acquisition up to 100 million ounces over 12 months. And you don't need to be a market analyst to understand what that means. The Pentagon is about to compete on the same physical market as China, and when governments compete for scarce material, price becomes a secondary concern. Access becomes everything. Then came the third order, the one that made the room at the Fed feel like the oxygen dropped. A Department of Justice investigation into precious metals manipulation, explicitly naming spoofing, naked shorting, coordinated suppression, and pushing for criminal charges against individuals. Not fines, not settlements, prison time. That changes the incentive structure, because a bank can survive a fine. A person cannot survive a prison sentence the same way. And suddenly, the people who authorize these positions are not just worried about money. They're worried about personal consequences. This is why Powell's situation is impossible. You can't bail out institutions you're prosecuting. You can't protect a structure you just declared criminal. And yet you also can to let major counterparties fail in a leveraged system without risking a chain reaction. That's the trap. That's the 48-hour window. Powell isn't choosing between good and bad. He's choosing between different forms of catastrophe. Inside that emergency framework, 4 paths exist, and none of them end cleanly. The first is the classic bailout, the emergency liquidity facility, the quiet printing of money to let short sellers cover and keep the system intact. That keeps banks alive, prevents immediate collapse, and pushes the bill onto the public through inflation, currency debasement, and hidden taxation. But this option runs into a political wall, because the new posture from Treasury and the White House is openly hostile to protecting institutions accused of manipulation. A bailout now isn't just financially toxic. It's politically explosive, and it would shred whatever credibility the Fed still has left. The second option is a trading halt. Freeze silver futures. Stop price discovery. Stop margin calls. Stop the bleeding. But a halt is a confession. It tells the entire world that American price discovery is fake, that the market cannot function under stress, that the system only works when nobody tests it. The moment you halt, you accelerate the migration of price discovery to Shanghai. You hand the narrative away. You hand the power away. And you weaken the dollar's position in a world already searching for alternatives. The third option is controlled demolition, letting bad actors fail while flooding liquidity into the broader system to prevent contagion. This is the free market answer. Consequences, accountability, real price discovery. But the risk is that contained failure is a myth in a system this interconnected. One major default can trigger collateral calls across everything. It spreads faster than policy can respond. And once that cascade begins, it becomes impossible to stop without shocking interventions that look exactly like the bailouts you promised you'd never do again. The fourth option is the nuclear one, force majeure by another name. A regulatory declaration that extraordinary circumstances make delivery impossible and therefore contracts will be cash settled at an administered price that has nothing to do with physical reality. That would be a soft default, a controlled breaking of promises, and it would permanently poison the idea that Western paper markets represent real ownership. But if Powell believes the alternative is systemic collapse, he may decide that preserving the broader machine is worth sacrificing the credibility of the silver market entirely. Now here's what matters, and this is where it becomes personal, because every one of these paths lands on your life differently. If you hold physical silver, you hold something outside the paper chain. It cannot be printed. It cannot be digitally frozen. It doesn't depend on the solvency of a counterparty. Its value can swing, but the asset itself doesn't vanish because a regulator changes the rules. Physical metal is the one form of ownership that doesn't require permission. But if you hold paper silver through an ETF, you are holding a claim, and claims are only as good as the settlement mechanism behind them. If a force majeure event hits, if cash settlement replaces delivery, if prices are administered instead of discovered, you may find out in the worst possible way that exposure is not the same as ownership. It's like believing you own a house because you have paperwork, only to discover 10 other people have the same paperwork for the same house. There is only one real asset, but there are many claims. And when everyone shows up at once, most claims get rejected. Bank deposits carry a different risk. Your money in a bank is not stored the way people imagine. In practice, it becomes part of the bank's balance sheet. You are a creditor. If a bank fails under stress, you stand behind secured parties. You stand behind institutions. And history has shown what happens when depositors become the buffer. Cyprus in 2013 wasn't a theory. It was a precedent. People woke up and discovered their safe money was used to absorb losses. 3 months ago, you could have dismissed that as distant. Today, with global counterparties strained and political appetite for bailouts collapsing, dismissing it outright becomes harder. So here's the question I want you to sit with, and I want you to answer it in the comments because it reveals how you see the world. If the system is forced to choose between protecting paper promises and protecting real people, who do you think they will save first, and what do you think they will sacrifice to do it? Because your answer tells you what you should prepare for long before the headlines admit what's happening. And while the West argues over optics and policy, the rest of the world is moving. Russia has signaled restrictions on silver exports. India is lifting barriers and absorbing metal culturally and financially at scale. Mexico, the largest producer, is facing labor disruptions that tighten supply right when demand is turning frantic. Industrial buyers aren't waiting for CNBC to explain it. They're calling mines. They're locking supply forward. They're signing contracts at any price because when this material is strategic, price becomes a footnote and access becomes survival. This is how shortages become crises, not because people panic emotionally, but because institutions panic logically. They do the math, they see the inventory, and they realize time is gone. Now, step back and look at what's happening to the real market on the ground, because this is where the paper narrative collapses completely. If you try to buy physical silver today, you will not pay the screen price. You will not pay the COMEX quote. You will pay the real world price, the price that reflects scarcity, shipping, premiums, and the fact that dealers cannot source inventory without bleeding out. That's why you're seeing retail prices far above paper spot, and that's why some dealers have stopped taking orders entirely. It's not that demand is high, it's that supply is not there at the official price. The system is discovering that a price can be published without being real. The US Mint slowing production, the claims of blank shortages, the rationed sales, the massive premiums, the weeks-long delays, none of that is an inconvenience. It's evidence that the physical market is already operating in a different reality. The paper market can claim $80 all at once, but if you can't buy at 80, then 80 isn't a price. It's a story. And stories die the moment people demand delivery. This has happened before, and history is the simplest truth filter we have. In 1971, the United States faced a similar contradiction. Foreign governments held dollars with a promise attached, exchangeable for gold under Bretton Woods. But the gold wasn't sufficient to satisfy all claims. The paper promises exceeded physical reality. Nixon had a choice. Admit the system was broken and reprice honestly, or break the promise to preserve control. On August 15, 1971, he closed the gold window. The promise was canceled. Paper stayed paper. Reality moved on without it. After that, gold went from $35 to $800. Silver surged by multiples. Not because metal got exciting, but because the lie was removed and price reconnected to scarcity. That is the dynamic now. Paper claims are reaching the edge of what physical inventory can support. When the gap gets too wide, the promise breaks. The only question is how, and the next 48 hours will answer it. Today, Wednesday, January 21st, the Fed is modeling outcomes behind closed doors, trying to choose a loss they can survive. Tonight, communication between the Fed, Treasury, and the White House will be frantic, because political reality is now part of the market equation. Tomorrow, Thursday, January 22nd, the CFTC faces an emergency decision point. Halt trading and confess the market is broken, or let it run and risk a cascade of margin failures that could spread like 2008, only faster and larger. By Friday, the path will be visible, not because someone announces it, but because the system will begin behaving differently. Defaults will appear, liquidity will disappear, or the rules will change in a way that tells you everything you need to know. And here's the deeper truth that sits under the silver story. Silver is not the only market built on paper claims. The global derivatives complex is measured in the hundreds of trillions and beyond, far larger than the value of physical assets that can actually settle those claims in stress. We built a civilization of agreements that assume counterparties will always perform, always deliver, always honor settlement, even when reality makes it impossible. That illusion can hold for years, even decades, as long as nobody challenges it. But the moment a market is forced to reconcile claims with inventory, the illusion collapses. Silver is simply the first weak seam where the stitching has started to tear. So understand this clearly. What you're living through is not a silver moment. It's a repricing of reality over fiction. Some people will be protected by owning what is real. Others will discover that their wealth was a promise made by a system that breaks promises when survival demands it. I'm not here to tell you what to buy. I'm not your financial advisor, and nothing in this video is investment advice. I'm here to tell you what's happening, why it's happening, and what it means when the people at the top start meeting in emergency protocol mode while the public still thinks the world is normal. Jerome Powell has 48 hours. The banks have 48 hours. The system has 48 hours. And then we see what was real and what was always just a promise. If this helped you understand the mechanics beneath the headlines, share it with someone you care about, because the people who get hurt the most in a transition like this are the people who never even knew a transition was happening. This is Money and Empires. Stay sharp, stay prepared, and I'll see you in the next one.